Good evening, everyone. Welcome to Eurodollar University. We've got a lot to talk about, especially given the situation in certain marketplaces and the interpretation of maybe a huge change in the political situation in the United States, leading to a potential rebound in economic fortunes and circumstances. I think that the so-called Trump trade has gotten not just quite a lot of attention, but it seems to have gotten a lot of people believing in it. And it's understandable why that would be, because anything different now, given where we just came from, seems like it has to pan out positively. After the last several years of, at best, sluggish growth, and at worst, economic and labor market circumstances that seem to be heading for a recession, just changing things up, and it seems like political government policies and everything else appear to be substantial enough that anything different is interpreted as good. So whatever you believe about the prospects for the Trump administration, what I wanted to do here today is to review where we are in this process before we even get to it. So regardless of what you think of Trump and what his potential policies might be, we do need to understand and really appreciate that there is a vast difference between 2024, the new Trump administration coming in 2025, versus where he was in 2016. When we really stop and look at things, the real comparison isn't to 2016 and where Trump started in his first administration. It more and more resembles 2001 at the very least. And we'll see, I'll show you what I mean in just a moment. So it's understandable that a different administration, something different must be good. And while that could potentially be the case, the challenge facing that new administration, regardless of how different it is far greater than is being appreciated, which means that we have a much bigger hole to dig out starting this time around versus other periods. That's why, again, it resembles a lot more of the Bush administration than not. So that's what we'll make our comparisons here. We'll compare to what's happening today with 2016 when Trump started the first time. So you can see the differences there. The contrast really sharpens what we're talking about, as well as we'll do some comparisons with 2001. Superficially, as well as more than just, the incoming Bush administration got the markets excited about the prospects of something very different, because the last year of the Clinton administration in 2000 was a lot like 2023 and 2024. Things were going wrong, and there was a lot of hopes pinned on the brand new, supposedly business-friendly Bush administration changing things up before the situation got to be what it actually became in 2001. So there's lots of comparisons that fit more with 2001 than 2016. And then beyond both of those, we've got much deeper and really a bigger challenge as far as the structural problems that are facing not just the U.S. economy, but the entire global economy, related to the leftovers from the supply shock of the last couple of years. It's just the nominal versus real problem, and it is a very real problem and a very big one for anybody to face, let alone governments. I mean, first of all, I think we give any administration, any governmental situation, we give them way too much credit, way too much blame at times for their ability to either impact the economy, or, and a lot of people believe that they actually change they actually run the economy. So there's a lot of things that we need to take into account before we even get to what the new incoming Trump administration might look like and what it might be able to accomplish. Because, like I said, the overriding theme here is that the challenge facing the administration as it comes in is far greater than is being appreciated right now. And it starts with the cyclical stuff. So if we compare just 2024 to 2016 to get a sense of what I mean here, just to sort of calibrate our expectations, look back at 2016 versus 2024. It starts with what a lot of people are using as a basis for comparison with 2016, and that's the sell-off in the bond market. Because in 2016, we also got the same thing that was triggered in large part by Trump's shock win in the 2016 presidential contest. And again, it was the same idea that after the malaise of the Obama administration, and by the way, this is not a partisan thing at all. For anybody that has watched this channel or knows me or has followed me for a very long period of time, they know that I don't care which party it is. As far as I'm concerned, they both absolutely suck when it comes to economics. Obviously, there's differences in other areas, but as far as economics go, this is a bipartisan failure up and all across the board. So when Trump was elected in 2016, there was the same immediate impulse that maybe something different would be better than the Obama administration. And let's also remember that Obama inherited the Great Not Recession from the Bush administration. So bipartisan failure up all along the entire history of the 2010s. So there's a major sell-off in the bond market, especially long-term interest rates in October and heading into in really November of 2016. Same thing as what we've seen here, though the sell-off in 2024 goes back to September of 2024, which wasn't necessarily triggered, in my opinion, by the rising prospects of a Trump victory so much as it was the usual historical pattern. And you'll see what I mean when we do the 2001 comparison. But other than that, that relatively superficial comparison, notice that the rest of the marketplace looks nothing like 2016. Whereas in 2016, we had short-term rates that were starting to rise, Fed starting to raise rates because the cycle had shifted from a downturn in 2014, 2015, and the early part of 2016. The Fed began raising rates because during reflationary periods, that's what the Fed does. They were recognizing the improving conditions that started to turn around before we even got to the real meat of the election season in 2016. Whereas in 2024, we're going in the opposite direction, not just in terms of Federal Reserve policy, but Federal Reserve policy that is a recognition of these cyclical conditions. So already beside the sell-off in the long-term part of the yield curve, the short-term part of the yield curve could not be more different, which is, again, the suggestion of the cyclical differences here. Comparing some of the macro statistics, you also see big change, big difference. Using the establishment survey payrolls, in 2015 into 2016, you saw some softening in the labor market, but it wasn't ever really too close to the recession danger zone. Certainly not in the establishment survey. A little bit different in the household survey as is usually the case. Whereas in 2024, especially over the summertime, you can see a real drop in the payroll numbers. And as I'll show in just a minute here, it's even worse when you factor in benchmark revisions that are coming. There's much more of a cyclical downturn evident in the payroll numbers in 2024 versus 2016. When you look at some of the other ones, you can see that in actuality, things were beginning to improve. Not necessarily the household survey. The household survey in 2024, much worse than in 2016. In fact, it's been worse for a lot longer, even though there's a lot of variation in the household survey. The average is close to zero. And in fact, employment in the household survey going back to last year is actually slightly negative. So for a 13-month period, employment, according to the CPS numbers, is lower. Whereas in 2016, it hit kind of back and forth. There was a little bit of an upturn late in 2015 and early 2016, and then back into maybe a little bit slower of employment growth in the latter part of 2016, but not really the same type of sharp cyclical downturn that you see currently in 2024. So much bigger danger this time around. The unemployment rate, however, going in different directions, that continued to move lower during 2015, though a lot of that had to do with labor force participation. We still have this labor force participation problem here in 2024, but the unemployment rate, even though it's low over the last couple months, that is continuing to be on the upside as well. Another cyclical indication that, unlike 2016, 2024 is already moving in the wrong direction toward the downside. Incomes, which is a huge one. I'm using the 6 month change here. You could also use the 3 month change to see the same thing. You can already see that incomes, which had slowed down, the primary reason why there was such a big downturn heading into 2015, had already begun to turn around in the middle of 2016 before we even get to the election. So nominal incomes were already starting to rise in the middle of 2016, whereas in 2024, they're going in the opposite direction. So that's another one that suggests the cyclical part of the economy, or the cyclical forces in the economy, are moving in the opposite direction here in 2024 versus what they were doing in 2016. Same thing for real incomes. Real personal incomes, excluding transfer receipts, which is one of the income statistics that the NBER uses to judge official recessions. Not that we necessarily care about the NBER, but this is a a very critical indication of how much income the private economy is generating and putting it in real terms. Not that there was a huge amount of consumer price changes or inflation in 2016, but again, you see that there was definitely a slowdown in 2015, consistent with the downturn, but another slowdown in early 2016, but it never went any farther than that. And by middle part of 2016 into the later part, before we get to the election of Trump, it was already moving back to the plus side. Whereas here in 2024, real incomes are actually worse than you can see on the chart here. It really understates the weakness. But on a cyclical basis, like all the rest of the data that we're going over here, from the beginning of 2024 and really the middle part of 2024, we're moving in the wrong direction. The cyclical direction is lower here, not heading back higher again. Energy prices. Energy prices were moving up off the bottom in 2016, whereas in 2024, they're moving in the opposite direction as well. And again, for the same reasons. Back in 2016, while everybody blamed low energy prices, oil and gasoline, on a supply glut, and they're doing the same thing here in 2024, it's really about demand. And so demand was beginning to come back, or at the very least, the energy marketplace in early 2016 forecast that demand was starting to come back, not just in the US, but globally, especially in China, as I'll go over in just a second here. So energy prices were on the rebound, which sounds like it's a bad thing. And it is in terms of individual consumers. Rising gasoline prices are always a tax on consumer spending power. But the circumstances that lead to energy prices going in one direction or the other are what we're really interested in. When oil prices are going up, that usually means that's because demand is rising due to the fact that the economy is, in this case, rebounding in 2016. Whereas in 2024, and this is not just about China, weakness across the global economy, including the United States, as we see in gasoline prices, is leading to a downturn in energy costs, which is, again, sounds like a good thing for individual consumers, but the reasons why energy prices are moving lower, that's what we're concerned about. And it's consistent with the different stage of cycle, 2016 versus 2024. 2016, things were starting to pick up by the middle of the year, whereas in 2024, we're still heading in the wrong direction. It's gotten to the point where the WTI curve is also nearly back in contango, which is not just the usual seasonal pattern that we see at this time of year. The entire energy market around the world is expecting that there will be a oversupply situation in the relative near-term future. That's more about lack of demand than it is necessarily about supply coming back from OPEC or replacement supply in various places around the United States, and especially the United States becoming the world's largest producer. Essentially, we have, again, 2016 versus 2024, energy prices on the upside in 2016, heading into the election, on the downside in 2024, and that didn't change with the election in 2024. Another one, copper to gold. That's a ratio I point out all the time. And copper to gold in 2024 has compared to the levels in 2016, back when China was falling off, emerging markets were experiencing conditions that were consistent with depression. So copper to gold got really low and then suddenly started to surge higher around September and October of 2016. Now, it did take a big leg higher around the election because that was another thing that was different, but I don't necessarily believe that was because of the Trump election, as it was Chinese stimulus spending was beginning to have a major impact in the general economy around the rest of the world, including its effects on copper, as well as a little bit of a depression in gold prices too. So copper to gold and copper prices, that's why copper to gold, the ratio was rising. Copper prices really began to soar September into October of 2016. Whereas in 2024, despite the fact that the Chinese are on the surface appearing to do the same levels of stimulus, at least the numbers being thrown around, it's nothing the same. I can assure you that. So despite the fact that the Chinese are doing a tremendous amount of stimulus here in 2024, the copper market, the gold market, they are not really buying it. Even though the copper and gold are both down over the last several days, copper is down more than gold is, which brings the copper to gold ratio back down toward its 2016 lows or its 2020 lows or late 2008 and early 2009. There is nothing that has shifted as far as the copper and gold prices that would suggest things are turning around. Again, another key cyclical indicator that we're still heading in the wrong direction as far as these cyclical swings go. And one last thing, comparing to 2016 Chinese bonds, as you can see there, Chinese bonds had begun to sell off right around the time that copper shifted. So September and really October heading into November of 2016, the Chinese bond market began to sense that there was at least a short run impact from Chinese government spending. The major stimulus package that was unveiled in 2016 started to have an impact in the middle part of that year, which was one of the major reasons that contributed to the cyclical upturn in the economy heading into late 2016 and into 2017, what became called globally synchronized growth. Whereas in 2024, we don't see, again, the same type of response from the bond market or really any market outside of the stock market, where it indicates a shift in the cycle from a downturn previously toward an upturn heading into the later part of this year or next year. Quite the contrary, from Chinese perspective, as well as all the others I've gone over, more signals that suggest the cyclical part of the US and global economy remain on the downswing. Very different circumstances in 2024 versus 2016. And it's not one thing or another. We're talking about copper to gold, which is more global. They'll focus a lot on China, Chinese bonds, therefore an indication of how the marketplace is viewing the potential for these Chinese government plans, which don't really amount to all that much. Energy prices on the upswing in 2016, on the downswing in 2024. The labor market in the US, a big one, especially nominal incomes. Nominal incomes are slowing way down into the danger zone, whereas in 2016, they were kind of on the way back up already, and they would continue to rise, especially in a period where consumer prices and inflation was much less back then versus now, which is why there's a big difference in terms of real incomes as well. So we step back and look at where we are in 2024 versus 2016. There are not a lot of similarities. In fact, there really aren't any. In terms of cyclical conditions in the economy, 2024 looks like it's heading lower, whereas 2016 was, as I say, keep saying, it was heading higher, which suggests a whole lot of similarities, not with 2016, more so with 2001, and more than you think, too. If you think back to 2001, if you're old enough like me, remember it, 2001 started out with under the cloud of suspicion and recession, but also there was a burst of optimism because of the incoming Bush administration. As I mentioned in the introduction here, the last year of the Clinton administration was not a good one. You had the dot-com bust, you had economic indications suggesting a downturn was coming. And then along comes the Bush administration saying, we're going to be more business friendly, because everyone always says that. But they also introduced especially major tax cuts. So along with the tax cuts, other policies that were promised and implemented, it sounded like maybe something big was happening, positive, that could get the U.S. economy out of its rut before a recession actually developed. And so when we look at what happened in 2001 versus 2024, you do start to see a lot more similarities because of that, where we were in 2001 in the cyclical process. There's a lot of cyclical indications like 2001 in 2024, starting with the bond market. And what you see in particular is that the sell-off that we're experiencing right now in 2024 is not unique. And I pointed this out in a recent video. We also saw a massive sell-off in the early part of 2001. And it was tied to, first of all, the Federal Reserve rate cuts. There was more optimism that an aggressive response by the Fed might be enough to also head off a recession before it happened. Because remember, back in 2001, there was a lot more faith and a lot less doubt and skepticism about interest rate policies coming off the 1990s and the great so-called moderation. So you had rate cuts from the Fed, and you had a major shift in what was deemed to be more accommodative fiscal policy, tax cuts from the Bush administration, and this should sound really familiar. So you had a more than 80 basis point sell-off in the 10-year U.S. Treasury between March of 2001 and May of 2001, even though those were the first 3 months of the dot-com recession. So you have a sell-off in the bond market based on hopes that stimulus, whether it be central bank policies or government policies, might actually work. And here we are in 2024 with very, very similar cyclical indications and a short run period where long-term rates are rising. At the same time, short-term rates are going in the other direction. That's also a key similarity now versus then. Short-term rates are moving lower using the 3-month Treasury bill rate here, whereas in 2024, they're doing the same thing. So the yield curve overall from the very front to the back is really steepening out, which is a consistent downside cyclical indication as well. Payroll reports, there's more similarities with the establishment survey in 2024 versus 2016. And it's actually even more of there's even more similarities when you consider that benchmark revisions mean that the current statistics that we have for the payroll numbers are wildly overstating what is already a weak case. And just plugging in a hypothetical plug for the QCEW, not even getting into some of the other revisions and overstatements, there's a lot more similarity than it even looks at just from the estimates that we have in hand from the BLS. So the payroll reports that we've gotten recently started to look more like the end of 2000 heading into 2001 too. Nothing like 2016, a lot more like 2001. Same thing with the household survey, though. Again, the household survey looks worse in the current period than in the months leading up to the dot-com recession. Again, lack of employment growth from the household survey is one of the defining features of the labor market over the last year. Again, it goes along with the fact that at the very least, whatever we think about layoffs, and remember, recessions are triggered by lack of hiring, and that's what the household survey has shown, and then some, consistent with past recession periods like 2001. So the lack of hiring that we have in 2024 is actually even worse than heading into the 2001 dot-com recession. So not a positive cyclical in the comparison there. The unemployment rate, which was slightly higher in the 2001 era than in 2023 and 2024, but still similarities in how the unemployment rate is behaving. And at the very least, they're moving in the same direction. The unemployment rises well in advance of the start of recession. In fact, it rises not all at once, but in a sort of gentle meandering increase over really a year or so before we ever get to the recession. And sure enough, that's exactly what we've observed of the unemployment rate over the last 13, 14 months, more than a year before the current statistics that we have for October. So another similarity, at least in the direction, as well as the behavior of the unemployment rate. Incomes, as I said, nominal income is incredibly important. Nominal incomes, after a big jump at the end of 1999 and early 2000s, a lot of that had to do with the dot-com era, the tail end of the dot-com era. That was one of the reasons why the year 2000 was as concerning as it was, because the labor market was indeed really slowing down. We saw that in terms of nominal income, which is always a recession trigger. And unlike 2016, in 2024, as I pointed out before, nominal incomes are slowing down. And they've slowed down quite a lot over the last several months. You see this even better on a 3-month change. But even on the 6-month change, slowing down, heading into what looks to be a further cyclical downturn here in 2024. And of course, real income, same type of thing, where you have the coming down from the high rates in the late 1999, early 2000, and then similar, though not nearly as good in terms of real income, would be 2023 comparing to 2000 versus 2024 comparing to 2001. There's similarities there. So again, another cyclical indication that suggests the economy is behaving like the early stages of the dot-com recession rather than coming out of the 2016 slowdown. And of course, another big one, the Federal Reserve. Federal Reserve cycle is nothing like 2016, where the Fed was just starting into their rate hiking cycle, recognizing the cyclical reflationary upturn. Whereas in 2024, it's like the Fed in 2000 and 2001, or in 2007, 2008, where they're beginning to cut rates, recognizing the weakness that we see in the cyclical parts of the economy, especially the labor market. So when we look back through all of these cyclical indications, there's a lot of similarities with 2001 versus 2016. What that means is that the Trump administration, by the time it is sworn in January, the economy is already heading in the wrong direction before we even get there. And that's not that we haven't even gotten to the worst part yet, which is the structural imbalances that are really the biggest challenge facing anybody, not just Trump administration in the US, but any governments around the rest of the world. It's the same issue. But on just the cyclical accounts, whether it be markets, bond markets, energy markets, whether it be economic data, especially labor data. The economy in 2024 is heading in the wrong direction before we even get to considering what Trump and his administration might be doing different on an economic basis. But the real big challenge, the real big difference here with everything, because we haven't seen a supply shock like this in several generations, really go back to the early 1950s. This is nothing like the great inflation of the 1970s. This is supply shock case. And this is really the reason why Trump won the election to begin with, because in poll after poll after poll after poll after poll after poll, American voters have said their number one issue is the economy. And what they meant is exactly what you see on this chart that I'm showing you here. Nominal incomes, which most economists and politicians have been pointing out, saying, look, what is everybody complaining about? Nominal income growth has been relatively good. But most people don't feel the nominal income. They feel it in real terms. And the difference there is gigantic. And so the challenge before the Trump administration is to somehow close that gap. And the problem is that it's not enough to have consumer price rates start to slow down and then real terms, the real series just magically closes with the nominal series. That's not how this works. Instead, what happens is, as we're seeing in the labor statistics, the nominal series begins to slow down and roll over. And while those two never necessarily converge, the nominal one's going to move closer to the real one rather than the other way around. That's the cyclical danger that we just went through. So we start from a huge gap between not just perceptions of income, but real purchasing power. That's what most people have complained about, is that they've lost so much purchasing power. And here you can see it just in one single chart. This is exactly the problem that led to the election results that we just got. But solving this is not as easy as just switching presidents and Congress and politicians around. It's not like you can just cut rates, because rate cuts never work. It takes something much bigger, especially given the fact that the cyclical shift in the economy is in the wrong direction on top of everything. So the Trump administration's got a couple different challenges that are much bigger than is being anticipated currently in the afterglow and euphoria of the last recession. And you can look at this, like I said, the difference between nominal and real is just enormous. And you look at this in terms of spending too. It isn't quite to the disparity that we see in other places around the world, like Japan or Europe, where the Japanese and the Europeans are spending more but getting less. That's true in the goods economy, but in services, not quite the same imbalance. But even here, you can see what American voters have been up in arms about. Nominal spending is way up here, but in real terms, it's way down here. What that means is Americans perceive that they're spending a lot more and paying a lot more, but not getting as much as they had before. This is, again, lost purchasing power. And it may not seem that big of a deal just looking at it on a static chart here, but this is a gigantic difference, and it means everything. And so the challenge here is to close that gap. And the way you close that gap is to have incomes in the labor market continue to grow and rise and quicken when, as I keep pointing out, those things are moving in the opposite direction. And now that they're moving in the opposite direction and have been moving in the opposite direction for a long period of time, it's not so easy just to turn around. Even if you believe Trump's policies will be effective in the real economy, they're going to take some time to have any positive impact anyway. So in a lot of ways, it is like the 2001 circumstance, though the tax cuts really didn't have that much effect. And it might actually be like the 1980s, where the incoming Reagan administration had a similar challenge, though different background circumstances, the great inflation versus supply shock, but the same kind of results, where the early 1980s saw repeated recession before the economy finally got going for a variety of different reasons, a lot of it having to do with the Eurodollar system reorienting itself. But the same type of cyclical and structural combination stands. The comparison there, the early 1980s. We had a recession in 1980 during the last year of the Carter administration that really sealed the deal for Reagan's victory. And then you had another deeper recession in the middle part of 1981 before the Reagan administration really got its feet underneath it. The economy just completely, not really collapsed, but it came close to that. It was the worst recession that we had seen in the post-war era up until 2007. And that was with a lot of faith, a lot of optimism in the brand new Reagan administration. But in the short run, whatever you think about the government's ability to impact the economy, in the short run, it's very limited, to say the least. So when we look at all of these challenges facing the incoming Trump administration, they're enormous. They're nothing like that we saw in 2016. In many different ways, they're certainly the structural challenges are a lot worse. I want to leave this with an example that came from the auto industry, which is what I keep pointing out the auto industry because it's the best example of this price illusion, nominal versus real, that we have. And it also encapsulates everything we're talking about as far as voter anger and the challenge that's facing the incoming Trump administration. As Bloomberg wrote earlier this month, people that are starting to buy cars, those who were the last group that were purchasing automobiles before the pandemic, are absolutely shocked to learn that new car prices are way above what they thought. They were thinking, as the Edmunds.com survey showed, most people are thinking new cars should pay around $35,000, when in reality, most new car prices on average are up around $50,000. And it's not a problem of expectations, nor is it necessarily a problem of prices. The supply shock and the lost purchasing power is really about incomes. As I showed in those charts, incomes have not kept up with prices. And so again, the challenge for the Trump administration is to, whatever you think his ability and the administration's ability to change economic circumstances, and I remain very dubious about those, but whatever you believe about them, the challenge is that the disparity between where prices are, and you can see in the chart here, new car prices absolutely soared in 2021 and the early part of 2022, and they've leveled off and gone slightly lower since then as demand has cooled, and in some places is really starting to fall off and inventories begin to pile up. But you'll notice that prices they're not collapsing, they're not falling. And we should not expect that prices across the economy are ever going to go back to where they were in 2019. So the challenge isn't to get prices to come down. The challenge here is really to get incomes in nominal, as steady nominal incomes, but really in real terms, to not just stay where they are or go higher, but to go a lot higher. They have a lot of ground to cover to get back to where American, not just consumers, but also businesses can be hopefully made whole from the supply shock and the price illusion. So like I said, the challenge here isn't, prices are not going to go back down, unfortunately, is to get the incomes to stay higher, and to do so with the cyclical part of the economy turning down, where businesses are already trimming their costs, controlling their payrolls, their workforce, they're trimming hours, all of the things that the opposite of what we need to see in the U.S. economy to get to have any chance of closing this purchasing power gap. So whether it be cyclical or structural, like I said, I've repeated myself a bunch of times here for emphasis. The challenges facing the incoming Trump administration are far, far and away greater than they were in 2016. And I believe that they're well more than most people believe, certainly those in trading in these markets that have gone completely crazy over the election of Trump. And a lot of that is, getting past the uncertainty of the election and everything else. But on purely an economic basis, the cyclical comparison is with 2001. There's way too many similarities there. And I'm not saying we're gonna have a same type of 2001 recession or anything, because you never have history never repeats exactly. But what I'm saying is that these cyclical indications look like they're heading into a recession in the same way that they did in 2001. There's a lot of similarities to 2007, as well as 1989 and early 1990. So that one's already working against Trump to begin with. And then you have the major structural imbalance from the supply shock, which is an enormous challenge for anyone. And it's not something that any government's going to be able to solve anyway, in my opinion. So there's a lot of stuff working against us here, whereas there might be a lot of positive expectations for the government being different than the last 4 years, but that doesn't necessarily face up to the real dangers that we have and the real economic imbalances that you just can't be cleaned up by switching from one president to the next. In fact, again, when we give governments and presidents way too much credit to begin with. It's a lot of downside potential here. And even, like I said, even if you do believe the Trump administration is going to do a lot that's right, and they do a lot that's right, it's going to take some time for that to actually bear fruit. And the clock on this the economy is already ticking. That's why we see energy prices going lower. That's why we see, outside of the current short-run sell-off in the Treasury market, interest rates tend to be going lower. Even the Federal Reserve recognizes the dangers and the downside here. That's why they're cutting rates. So a lot of stuff pointing in the wrong direction. And I think it's worth stopping here before we even get to January and recognizing the direction that everything is heading, as well as where we're starting from.